Friends, thank you for being here today. What if I told you that the price you see on your screen right now, that number flashing at $60 per ounce of silver, is a mathematical fiction? What if I told you that you cannot actually buy physical silver at that price, not in any meaningful quantity, not from the institutional vaults that have anchored this market for a century? You would probably think I was exaggerating. You would assume that if the price is real, the metal must be available. But here is the uncomfortable truth we need to confront together. The largest bullion vaults in the Western world, the COMEX in New York and the LBMA in London, are experiencing something that hasn't happened in modern financial history. They are running out of physical metal. Let me put this in perspective. In the first 4 days of December 2025 alone, 60% of all registered silver, that's the metal actually available for immediate delivery, was claimed and removed from the COMEX vaults. Not borrowed, not rolled forward, claimed, taken, gone. We're not talking about a gradual drawdown over months or quarters. We're talking about 47.6 million ounces demanded for physical delivery in 96 hours. To understand the scale of what's happening, you need to grasp one number: 820 million ounces. That is the cumulative supply deficit over the last 5 years. The world has consumed nearly 1 billion more ounces of silver than it has mined. We have been eating into the strategic stockpiles of the last century, and now, friends, we are scraping the bottom of the barrel. But here's where it gets truly surreal. Historically, 98% of silver futures contracts are settled in cash. Only 2% of traders actually take physical delivery. The entire edifice of the paper market is built on this assumption that the vast majority of participants are speculators who will take their profit or loss in dollars and walk away. The vaults only need to hold enough metal to satisfy that tiny 2%. But something fundamental has changed. Traders don't want cash anymore. They want the metal. And when even 5% demand delivery instead of 2%, the entire architecture collapses. This is not a projection. This is not a warning about something that might happen next year. This is vanishing in real time. Now, you might be asking yourself, if there's a shortage, why isn't the price exploding even higher? Why are we at $60 and not $100 or $200? That question reveals what I call the big secret of the entire system. The price you see is determined by paper contracts, futures options, ETFs, traded in virtually unlimited quantities. The physical market, where actual metal changes hands, is a fraction of that volume. For every 1 physical ounce sitting in a vault, there are an estimated 300 paper ounces being traded on exchanges. As long as everyone is content to trade these paper claims back and forth, the system functions. But the moment people start demanding the actual metal, the illusion vaporizes. And friends, that moment has arrived. Let me show you the mathematical reality of what we're facing. The silver market is currently in something called backwardation. For those unfamiliar with the term, it means the spot price, the price for immediate delivery, is higher than the futures price, the price for delivery months from now. This is unnatural for a non-perishable commodity. Under normal conditions, the futures price should be slightly higher because of storage costs and the time value of money. When backwardation appears, it's a signal that screams one word: shortage. The market is literally saying, I will pay you more to give me the metal now than to promise it to me later. The trust in future delivery has evaporated. This is the bond market sending up a flare. This is the vigilantes telling you the edifice is cracking. To understand how we arrived at this precipice, we need to go back to the genesis of this crisis. This story doesn't start in December 2025. It starts decades ago, and the echoes of history are deafening if you know how to listen. In 1980, two brothers named Hunt tried to corner the silver market for profit. They borrowed heavily, bought aggressively, and drove the price from $6 to $50 in a matter of months. The establishment, the exchanges, the regulators, the banks crushed them. They changed the rules mid-game, limited speculative positions, forced liquidation, and the Hunt brothers were bankrupted. The lesson the market learned was simple: don't mess with the silver market. Speculators can be banned, margin requirements can be changed, positions can be forcibly closed. The system has tools to defend itself against profit-seeking manipulation. But here's the twist that changes everything. Today's Hunt brothers aren't two Texas billionaires trying to flip silver for a quick profit. Today's buyers are Tesla, Apple, solar panel manufacturers, and defense contractors. They aren't buying to speculate, they are buying to build. You cannot print silver the way the Federal Reserve prints dollars. You cannot substitute it in high-tech applications. It is the most electrically conductive, thermally conductive, and reflective metal on Earth. Every iPhone, every electric vehicle, every solar panel, every 5G tower requires silver. And the Green New Deal, the global push toward renewable energy, has created what I call the Solar Vortex, a demand black hole that is mathematically impossible to fill. 20 years ago, solar panels consumed 0% of global silver production. Today, they consume 20%, and that percentage is rising every single year as nations race to meet climate commitments. You can ban speculators like the Hunt brothers, but you cannot ban Apple from buying silver without crashing the global economy. The demand is now inelastic, it is structural, and it is accelerating. This leads us to the system's most crucial secret, which we will explore in just a moment. But first, let me explain the mechanism that has kept this crisis hidden for so long. It's a practice called rehypothecation, and it's the reason the vaults appeared full even as they were being drained. Think of it like musical chairs. Imagine 300 people in a room, and there are only one chair. As long as the music is playing, as long as prices stay relatively stable and nobody demands to sit down, everyone can keep walking in circles, confident that when the time comes, there will be a seat available. The vault operators, the exchanges, the banks, they've been playing this game for decades. They take one physical bar of silver, create a warehouse receipt for it, and then lend that receipt out. The borrower uses it as collateral to borrow more. That collateral gets lent again. The same bar gets rehypothecated multiple times, creating multiple claims on the same physical metal. This isn't a conspiracy theory. This is standard practice in the commodity financing world, and it works beautifully as long as only a tiny fraction of people ever demand actual delivery. But when the music stops, when delivery demands spike, 299 people are left holding worthless paper. We are watching the music stop. The simple logic that governs your household finances does not apply here. In your world, if you loan something to someone, you don't have it anymore. In their world, one bar becomes 10 claims, 10 claims become 100, and the entire pyramid rests on the assumption that the bottom will never be tested. That assumption is now being tested. Here's what that looks like in practice. The COMEX divides its silver inventory into two categories: eligible and registered. Eligible silver is metal stored in the vaults, but not available for delivery against futures contracts. It's either owned by investors who are just using the vault for storage, or it's encumbered by other claims. Registered silver is the metal that is actually available to fulfill delivery obligations. It's the real inventory. In early December 2025, before the drain began, registered silver at the COMEX stood at roughly 79 million ounces. Within 4 days, 47.6 million ounces were claimed. That's 60% of the available inventory gone in less than a week. At this rate of withdrawal, the registered category would be completely empty within days. Now, the exchange can, and likely will, move silver from eligible to registered to replenish the delivery stockpile. But here's the problem. Most of that eligible silver is owned by ETF investors who bought shares in funds like SLV, believing they own physical silver. If the exchange starts raiding those inventories to satisfy delivery demands, those ETF investors are going to wake up to a very unpleasant surprise. Their silver is gone, and they're left holding shares in a fund that no longer has the metal to back them. This is a default in all but name. And it's not just happening in New York. London, home to the LBMA, the London Bullion Market Association, is experiencing the same phenomenon. The premium on physical silver in Shanghai compared to London has exploded. Metal is flowing east and not coming back. Sovereign buyers, nations, are skipping the banks entirely and taking bars directly into their central bank vaults. The West is being systematically drained of its strategic metal reserves, and the majority of people have no idea it's happening. Let me give you a specific, tangible example of what this looks like on the ground. There's a company you've probably never heard of, a solar panel manufacturer in Arizona that placed an order for 500,000 ounces of industrial silver in early November. Standard practice. They'd done this dozens of times before. The contract stipulated delivery within 30 days. December came and went, then January. The supplier kept pushing back the delivery date, offering excuses about logistics, transportation delays, documentation issues. Finally, in late January, they received a letter. The supplier couldn't deliver the physical metal. They offered to settle the contract in cash at the spot price plus a 15% penalty. The company refused. They needed the silver, not dollars. They took the supplier to arbitration. And here's what they discovered during discovery. The supplier had sold the same 500,000 ounces to 11 different buyers. They never had the metal. They were betting that most contracts would be rolled forward or settled in cash, just like they always had been. But this time, everyone wanted delivery. The supplier filed for bankruptcy 3 weeks ago. You won't find this story in the Wall Street Journal, but it's happening in industrial supply chains across the country. This is the canary in the coal mine. When I talk about the vaults running dry, I'm not speaking metaphorically. I'm describing a physical reality that is breaking the supply chains of American industry. And the most terrifying part, the companies that need silver the most, the Teslas, the Apples, the defense contractors building missile guidance systems, they saw this coming. They've been quietly securing multi-year supply agreements, locking in metal at any price because they understand something the average investor doesn't. In 6 months, it won't matter if silver is $50 or $500 per ounce. What will matter is whether you can get any at all. We are moving from a price problem to an availability problem. This is what I call the unobtanium moment, the point at which an asset transitions from expensive to unavailable. Now, let me address the question that's probably forming in your mind right now. You're thinking, if this is true, why isn't this all over the news? Why aren't the financial networks covering this? That's exactly the right question to ask, and the answer reveals everything you need to know about how modern markets actually function. The financial media reports on price. They show you charts that go up and down. They interview analysts who predict whether silver will hit $70 or fall back to $50. But price is a derivative of liquidity. And liquidity is something that doesn't show up on a chart until it's already gone. By the time the mainstream media reports that the COMEX has failed to deliver on contracts, by the time they acknowledge that the vaults are empty, you will have already lost your opportunity to act. The window for preparation closes silently, without fanfare, without headlines. Let me show you the forensic evidence of what's really happening beneath the surface. There's a metric that professional traders watch, but retail investors almost never see. It's called the GOFO rate, the gold forward offered rate. Silver doesn't have an equivalent published rate, but the same dynamics apply. When physical metal becomes scarce, the forward rates go negative. This means someone is willing to pay you interest to borrow your metal now and return it later. Think about that. Under normal conditions, if you lend something valuable, you charge interest. But in a shortage, the borrower pays you interest just for the privilege of accessing physical metal today. The GOFO rate for gold went negative during the 2008 financial crisis and again in 2013. It was a warning sign that very few people understood. Those who did bought physical metal and watched paper fortunes evaporate while their bars held their value. Here's another piece of evidence that mainstream analysts are ignoring. Look at the spread between physical premiums and spot price. When you go to buy a physical silver bar or coin right now, you're not paying $60 per ounce. Depending on the size and form, you're paying anywhere from $70 to $80 per ounce. That $10 to $20 premium isn't profit for the dealer, it's a market signal. It's telling you that physical metal is scarce and the spot price is a fiction maintained by paper trading. The premium is the real price, and it's rising every single week. In a functioning market, premiums should be tight and consistent. When premiums explode, it means the physical and paper markets are disconnecting. We are watching a structural break happen in real time. Now, I want to take you back to 1980 for a moment because the parallels are instructive, but the differences are everything. When the Hunt brothers drove silver to $50, the government and the exchanges intervened. They raised margin requirements, which meant speculators had to put up more cash to hold their positions. They instituted liquidation-only trading, which meant you could sell but not buy. They choked off the leverage that was fueling the buying, and it worked. The price collapsed from $50 to $10 in a matter of weeks. The Hunt brothers were wiped out, and the establishment breathed a sigh of relief. The system had defended itself. But here's what's different this time. The buying isn't driven by leverage. It isn't driven by speculators on margin. It's driven by industrial necessity and sovereign accumulation. You cannot raise margin requirements on Tesla. They're buying with cash from their balance sheet. You cannot impose liquidation-only trading on China. They're accumulating physical metal in their central bank vaults, and they're not trading it on Western exchanges. The tools that worked in 1980 are useless now because the nature of the demand has fundamentally changed. This is not a speculative bubble that can be popped. This is a structural deficit that can only be resolved by price rising until demand is destroyed or until the paper market simply fails to deliver and the entire mechanism collapses. Let me paint you the picture of what that collapse looks like. Imagine you own shares in SLV, the most popular silver ETF. You bought it because you wanted exposure to silver without the hassle of storing physical bars. The fund's prospectus says that every share is backed by physical silver held in vaults. You check the fund's website and it shows hundreds of millions of ounces in storage. You feel secure, but here's what the fine print says, the fine print that almost nobody reads. The fund has the right, under certain circumstances, to settle redemptions in cash rather than metal. If the trustees determine that delivering physical silver would be difficult or impractical, they can simply pay you the cash equivalent and call it a day. Now, imagine a scenario where delivery demands spike, the vaults run dry, and the fund announces that it's suspending physical redemptions, the share price would crater. You'd be left holding a piece of paper that's worth a fraction of what you paid, while people who own physical bars watch the value of their metal skyrocket. This isn't hypothetical. This is exactly what happened with some gold ETFs during the liquidity crisis of 2020. Premiums on physical gold coins went to 20% and 30% above spot, while the ETFs traded at a discount. The paper and physical markets disconnected, and the people holding paper got crushed. And this brings me to the most unsettling realization of all. The current price of silver, that $60 number on your screen, is not expensive by historical standards. In fact, it's still absurdly cheap. Let me show you why. In January 1980, silver peaked at $49.45 per ounce. Adjusted for inflation using the official CPI, that's roughly $150 in today's dollars. But the official CPI dramatically understates real inflation because the government changed the methodology in the 1990s to make inflation appear lower. If you use the original methodology, the one that was in place in 1980, silver's inflation-adjusted peak is closer to $650 per ounce. Even if we take the conservative number, $150, silver at $60 today is still 60% below its historical high. This isn't a bubble. This is a repricing of a suppressed asset that is catching up to 40 years of monetary debasement in a single quarter. But the inflation adjustment only tells part of the story. What really matters is the supply-demand fundamentals, and those fundamentals are unlike anything we've ever seen before. In 1980, silver was primarily a monetary metal and an industrial input for photography. Today, photography uses almost no silver, but electric vehicles, solar panels, 5G infrastructure, medical devices, and advanced electronics have created entirely new categories of demand that didn't exist 40 years ago. A single Tesla Model 3 contains roughly 1 kilogram of silver. A solar panel installation for an average home requires about 10 ounces. A 5G cell tower uses approximately 5 pounds of silver in its circuitry. Multiply those numbers by the millions of units being produced every year, and you start to understand the magnitude of the demand that's coming. And here's the kicker. This demand is mandated by law. Governments around the world have signed climate agreements that legally require them to transition to renewable energy. The European Union has mandated that all new cars must be electric by 2035. China has committed to carbon neutrality by 2060. The United States has pledged to cut emissions by 50% by 2030. These aren't aspirational goals. These are legal commitments backed by the force of law, and every single one of them requires silver. The Green New Deal, in all its various international incarnations, is mathematically impossible without depleting every ounce of above-ground silver and mining far more than is geologically feasible. The solar vortex I mentioned earlier isn't slowing down, it's accelerating. And nobody in government has bothered to ask the question, where is all this silver going to come from? The answer, friends, is that it's not going to come from anywhere. Global silver mine production peaked in 2016 at roughly 900 million ounces per year. It has been declining ever since. Current production is around 820 million ounces annually. Meanwhile, global demand, industrial plus investment, is running at over 1 billion ounces per year. That's a structural deficit of 200 million ounces every single year. For 5 consecutive years, the world has consumed more silver than it produced. The cumulative deficit of 820 million ounces I mentioned earlier, that came from somewhere. It came from above ground stockpiles, the inventories held in vaults, the strategic reserves held by governments, the old bars sitting in vaults in London and Zurich. We've been eating the seed corn, and now the seed corn is gone. Let me give you one more piece of evidence, and this one is the most damning of all. There's a phenomenon happening in the physical market that very few people are talking about. It's called the Shanghai premium. The spot price of silver in Shanghai is trading at a significant premium over the spot price in London and New York. At times, the premium has been as high as 10% to 15%. This is not supposed to happen. In a globalized market with efficient logistics, prices should equalize through arbitrage. If silver is cheaper in London, traders should buy it there and ship it to Shanghai to sell at the higher price. The price differential should disappear within days or weeks. But it's not disappearing, it's widening. And the reason is simple: the metal is flowing east and it's not coming back. China, India, and other Asian nations are accumulating physical silver and they're storing it domestically. They're not sending it back to London to be leased and rehypothecated. They're taking it out of the Western financial system permanently. China, India, and other Asian nations are accumulating physical silver and they're storing it domestically. They're not sending it back to London to be leased and rehypothecated. They're taking it out of the Western financial system permanently. This is sovereign accumulation, and it's happening in complete silence. Central banks don't issue press releases when they buy silver. They don't report their strategic metal reserves the way they report gold reserves. But if you watch the flow of physical metal through customs data, if you track the shipments from COMEX approved vaults to Chinese bonded warehouses, you can see the pattern. The West is being drained and the East is stockpiling. This isn't just about investment. This is about nations positioning themselves for a world where hard assets matter more than paper promises. Now, let me bring all of these threads together because we are facing what I call a convergence. Three distinct forces hitting simultaneously, and each one alone would be enough to break the market. Together, they create a perfect storm. Force number one, industrial necessity. The green energy transition has created inelastic demand that cannot be reduced without abandoning legally binding climate commitments. Force number two, monetary debasement. Every major central bank in the world is running deficits that can only be financed through money printing, which makes hard assets the only rational store of value. Force number three, the short squeeze. The paper market has sold claims on metal that doesn't exist, and when those claims are called, the entire structure implodes. Each of these forces is accelerating, and they're all converging right now in the first quarter of 2026. Let me walk you through what happens next, step by step, so you understand the mechanism of the crisis that's unfolding. First, the delivery demands continue to spike. More industrial buyers, more sovereign buyers, more investors who've done their homework, they all start demanding physical metal instead of accepting cash settlement. The registered inventory at the COMEX continues to drain. Within weeks, possibly days, registered silver falls below the level required to satisfy outstanding delivery obligations. At that point, the exchange faces a choice. They can either declare force majeure, a fancy term for we can't deliver what we promised, or they can raid the eligible inventory to replenish registered. If they choose force majeure, confidence in the entire futures market evaporates overnight. If they raid eligible inventory, the ETF holders and vault storage customers discover that their metal has been pledged to satisfy someone else's claim. Either way, the illusion shatters. Second, once confidence breaks, the rush for physical metal becomes a stampede. Premiums on bars and coins explode from $10 over spot to $30, then $50, then higher. The mints, the US Mint, the Royal Canadian Mint, the Perth Mint, they all run out of inventory and suspend sales. You'll be able to see the price on your screen climbing to $80, $100, $150 per ounce, but you won't be able to buy any metal at any price. The phone lines to dealers will be jammed. The websites will crash. And the people who waited, the people who thought they had time, will be left holding cash that's losing purchasing power by the day with no way to convert it into tangible wealth. Third, the industrial supply chains start to fracture. Tesla can't get the silver it needs for battery management systems. Apple can't source the silver for iPhone circuit boards. Solar panel manufacturers shut down production lines. Defense contractors building radar systems and missile guidance technology face critical shortages of an irreplaceable strategic material. At that point, the US government faces a national security crisis. They will have to choose: do they let the free market price silver at whatever level is necessary to balance supply and demand? Or do they intervene with price controls, export restrictions, nationalization of domestic mining operations? History tells us they will choose intervention. And when they do, the official price becomes meaningless. A black market emerges where physical metal trades at multiples of the official price, and the only people who have access are those with the right connections. Now, I need to talk about something uncomfortable, something that most financial commentators won't address because it challenges the fundamental assumptions we've been taught to accept. I need to talk about normalcy bias. Human beings are hardwired to believe that tomorrow will look like yesterday. We extrapolate from recent experience and assume that the patterns we've observed will continue indefinitely. You've been able to buy silver whenever you wanted your entire life. You go to a dealer's website, you place an order, it shows up at your door a week later. That experience has conditioned you to believe that silver will always be available, but that belief is not based on fundamental analysis. It's based on the accident of living through a period of relative abundance. Your grandfather, if he lived through the 1930s or the 1970s, would have a very different perspective. He would remember times when certain goods simply vanished from store shelves, when prices didn't matter because there was nothing to buy. Normalcy bias is why people don't prepare until it's too late. It's why they wait until the hurricane is 24 hours away to stock up on water and batteries, only to find the stores already emptied. It's why they wait until the bank run has already started to withdraw their deposits, only to find the ATMs empty and the branches closed. And it's why the vast majority of people will wait until the silver shortage is headline news before they try to acquire physical metal, at which point the opportunity will have already passed. The prepared don't wait for confirmation. They don't need the mainstream media to validate their concerns. They see the fault lines, they understand the mathematics of what's coming, and they act while there's still time. Let me be very clear about what I'm not saying. I am not predicting the exact date when the COMEX will fail to deliver. I am not telling you that silver will hit $200 per ounce by March or June or any specific time frame. Market timing is a fool's game, and anyone who claims to know the precise moment of a crisis is either lying or delusional. What I am telling you is that the structural conditions for a crisis are already in place. The deficit is real, the vault drain is real, the industrial demand is real, the paper to physical ratio is unsustainable. These are not opinions, these are measurable facts. The only question is timing, and timing is determined by psychology, by the moment when enough people lose confidence in paper claims and demand physical delivery. That moment could be triggered by a geopolitical event, a bank failure, an exchange default, or simply by the slow accumulation of awareness as more people figure out what's happening. I don't know what the trigger will be. but I know the powder keg is in place, and every day that passes adds more fuel to the inevitable explosion. So let me give you the binary choice that every person listening to this needs to make. On one side, you have paper claims. You have shares in ETFs like SLV. You have futures contracts. You have certificates of deposit with promises that metal is stored on your behalf. These are convenient. They're liquid. You can buy and sell them with a click of a button, but they are claims on assets, not the assets themselves. And in a crisis, claims get defaulted, settlements happen in cash, and you discover that the metal you thought you owned was never really yours. On the other side, you have physical possession. You have bars in a safe, coins in a vault, metal that you can hold in your hand. It's inconvenient, it's illiquid, you have to worry about storage and security, but it's real. When the paper markets freeze, when the exchanges suspend trading, when the banks close their doors, physical metal maintains its value because it exists outside the financial system. It cannot be defaulted on. It cannot be rehypothecated. It cannot be diluted by a keystroke. The question you have to ask yourself is this: do you own assets or do you own claims on assets? Because the difference between those two things is the difference between wealth preservation and wealth destruction. And we are entering a period where that difference is about to become painfully clear. I'm not telling you to put your entire net worth into silver. I am not telling you to sell your house and buy bars. What I am telling you is that some allocation to physical precious metals, silver and gold, is not speculation. It is insurance. It is stepping out of the line of fire. It is acknowledging that the financial system you've trusted your entire life is built on leverage, promises, and paper, and that when those things fail, the only thing that matters is what you can physically hold. Let me address one final objection that I know some of you are thinking right now. You're thinking, if this crisis is so obvious, why aren't the big institutional investors buying physical silver? Why aren't the hedge funds loading up on bars? The answer is that institutions cannot own physical metal at scale. If you manage a $10 billion pension fund, you cannot take delivery of 150 million ounces of silver and store it in a warehouse. The logistics are impossible. The insurance costs are prohibitive. The auditing requirements are nightmarish. Institutions are forced by their size and structure to operate within the paper markets. They have to buy ETFs, futures, mining stocks, instruments that can be traded in size without the hassle of physical delivery. This is why the coming crisis will transfer wealth from institutions to individuals. The large players are trapped in a system that's breaking. The small players, the individuals who can take delivery of 100 ounces, 1,000 ounces, 10,000 ounces, and store it themselves, they have the advantage for the first time in modern financial history. Friends, we are living through a transition. It's a transition from illusion to reality, from paper wealth to tangible assets, from a system built on confidence to a system tested by scarcity. The silver market is the canary in the coal mine for the broader financial system because silver is small enough and critical enough that the illusion breaks first. But what's happening in silver is a preview of what will eventually happen in other markets, in bonds, in currencies, in all the paper instruments that have been stacked on top of an ever-shrinking base of real assets. The liquidity tide is going out, and we are about to find out who is swimming naked. You have a choice to make, and you need to make it while you still can. You can wait for more confirmation, more data, more mainstream validation. You can wait until the crisis is undeniable, until the experts on television are finally discussing what's happening. But by then, the window will have closed. The premiums will be astronomical. The dealers will be out of stock. The mints will have suspended production. Or you can act now while physical metal is still available, while the premiums are still reasonable, while you can still exchange paper currency for hard assets on terms that make sense. History favors the prepared. It favors those who see the structural fault lines before they rupture, who understand that mathematical realities eventually overwhelm political promises, who recognize that in times of crisis, tangible beats intangible every single time. The window for preparation is not closed yet, but it is closing. The vaults are emptying in real time. The registered inventory is draining. The industrial buyers are panicking. The sovereign buyers are accumulating in silence. And every day that passes without action is a day closer to the moment when price becomes irrelevant because there's simply nothing left to buy. This is not financial advice. I am not a registered investment advisor. I cannot tell you what to do with your money, but I can tell you what I see. I can tell you what the data shows. I can tell you that a crisis decades in the making is reaching its final act, and the people who position themselves accordingly will preserve their wealth, while those who cling to paper promises watch their purchasing power vaporize. The choice, friends, is yours. But the clock is ticking, and the sand in the hourglass is running out. Thank you for being here today. Thank you for taking the time to understand what's really happening beneath the surface of the markets. And whatever you decide to do with this information, I hope you'll approach it with the seriousness it deserves. We are not living in normal times. The rules that governed the last 40 years are breaking down, and in the chaos that follows, the prepared will inherit the wealth that the unprepared are about to lose. Be safe, be smart, and be ready.